Okay, so thank you everyone for coming. This is a workshop that's made possible through the USDA STAR SDGG program. Today we'll have Kevin Ford talking about accounting for workshops, and I will just hand it over to him, and he's going to be the main person, leading this talk.
Thanks, Sophia. Good morning. How's everyone doing? It's okay. We can do this conversational wise. At least I hope that's how we'll do it. So what I'm going to do is I'm going to go ahead and share my screen, and I'll go ahead and bring up the presentation. And throughout the presentation, obviously, we'll be mostly looking at the slides. But I do hope that we can kind of keep this as more of a conversation rather than a lecture. Let's see. I'll bring it up the screen now. All right. Is everyone able to see the slide presentation? Yeah. Okay. All right. So as Sophia stated, the presentation is made possible by the STAR School SDGG program and the partners that are expressed here on the slide. And we definitely appreciate their support and for making this opportunity available. In today's agenda, I first will start by introducing myself. My name is Kevin Fort. I am a member of the Choctaw Nation out of Oklahoma. In 2016, after a approximate 20-year career in the world of finance and accounting, I started my own firm called the Regenerative Business Institute. One of the precursors for that was following an IPO for a now publicly traded natural grocer that is headquartered there in Phoenix. It starts with an S and ends with a Sprouts. After experiencing kind of the realities of what occurs after an IPO takes place, particularly to the communities and the employees that were involved with helping the company get to that position, I decided that I wanted to take a different route with my education, my career, and really focus on employee ownership structures and how we can make sure that there's a proper alignment of incentives when it comes to structuring the businesses and the entities that we use to support the programs and the projects that we work under and work with to help bring these things to fruition. And so that kind of brings me up to where I am today. I continue to develop projects globally. We're currently engaged in 3 major cooperative projects in the South Pacific. One of them is in the island of Vanuatu, and 2 of them are on Fiji. And I've been doing cooperative development primarily in the South Pacific and the United States since 2016. I really enjoy it. I really enjoy the prospect and the aspects that are involved with everything from beginning stage development all the way through to some of the complex topics that we're going to be discussing today that affects accounting for cooperatives, and in particularly the accounting for liabilities and equity aspects. The fundamentals of accounting, the reason, and if those in the presentation have a background in accounting and this is a little bit too foundational, please don't be afraid to speak up. I'm more than happy to shift the presentation to tailor it to what your needs are based on your experience and comfort with the subjects and the topics that we're discussing. But I am going to start with the fundamentals just to make sure that we're addressing this from what my perspective is probably one of the most important aspects of any accounting system that we're going to create for these structures, because if the fundamentals aren't there, then the rest of it really, quite frankly, doesn't matter. The data that comes out of it is really, it's either detrimental to good analytics, or it just doesn't provide valuable information to support effective decision making. Once we get through the fundamentals, I'll cover the policies, the procedures, and the accounting manual. So those are 3 areas that any organization needs to have, and it needs to be sound, and it needs to be, quite frankly, professionally written to make sure that it is encompassing of the legal documents that have been used to establish your entity, as well as management's vision for where the organization is going to grow to. And so we'll cover that. Specifically want to address, although it will be brief, but I definitely want to address cooperative accounting on Navajo Nation and businesses that are registered with Tribal Council. We're going to talk about accounting's role in the 21st century. And this particular portion of the workshop, I'm going to open it up to the group, and I would like for all of us to participate. It's easy enough for me to share what my vision of accounting's role in the 21st century is, given the work that I do on a daily basis, but I'm really interested in having that conversation with the group to see what you guys think is accounting's role as we move forward. And then we're going to dive into probably one of the most critical aspects of accounting for cooperatives, regardless of where you're at. And that's going to be what falls under the International Accounting Standards, or IAS 32. So this is going to specifically deal with the reporting of financial liabilities and equity and how those are classified within an organization. And then lastly, we'll discuss fiduciary responsibility for management and shareholders of the cooperative. If there's no other questions immediately, then I'll go ahead and jump in. And please forgive me if I'm having to kind of whisper down. I'm in a library. I live on a sailboat and it gets kind of loud when we're on the sailboat. So, okay, so right into the fundamentals. So here's the things we're going to discuss. We're going to go over the chart of accounts. From my perspective as an accountant, the chart of accounts is it's the most important place to begin with. If your strategy is not sound with the chart of accounts, then things can get pretty messy pretty quick. So what I would like to do is kind of outline the purpose and the role of the chart of accounts, and then a strategic approach to managing the chart of accounts and what organizations need to keep in mind when it relates to the chart of accounts. We're going to discuss briefly dual and double entry bookkeeping and why we use it. We'll discuss the general ledger and what its role is. We'll discuss financial reporting. I'm going to give you a different spin on financial reporting. I find that most people, when we talk about financial reports, if they don't have a strong background in accounting or finance, that certain reports, specifically the cash flow statement or the balance sheet, can be quite intimidating. And what I would like to do in this particular session is kind of peel back some of the layers of what these reports contain and maybe give you an overall different perspective of what the report is actually trying to tell you, in hopes that that alleviates some of that intimidation. Then we'll go over documentation and what documentation co-ops or any organization needs to maintain, and the process that's required to maintain those. And then we'll specifically discuss member accounts. This area is going to directly relate to co-ops and employee-owned companies. So we'll discuss those accounts that are specific to those structures to make sure that we address that in the fundamentals aspect of accounting. So the chart of accounts is the backbone of our accounting process, right? So it's essentially a long list of numbers and account names that helps us decipher or record or identify where transactions are going to be recorded to in the accounting process. And regardless of whether you're using, an Excel spreadsheet or a mid-level or sophisticated accounting system, the chart of accounts is always going to be the same in theory. It's a list of account numbers and account names that are usually classified in sections to help the accountant or the bookkeeper identify where those transactions are going to be recorded. The key thing about the chart of accounts is that it enables the double entry bookkeeping process. And every regulating body on the planet now, whether we're talking about US GAAP under the Financial Accounting Standards Board or under IFRS from the International Finance Reporting Standards, is required to use double entry bookkeeping. It is used to facilitate the budget and the forecasting process. So organizations that are, quite frankly, well organized and properly functioning from a financial and operational standpoint, they actually break their budgets and their forecast down by line item of the chart of accounts. So that way, regardless of whether we're talking about the direct costs for those items that are responsible for generating revenue, or whether we're breaking that down even further into the variable and fixed costs of the overhead expenses in the business model, we can actually start to forecast and budget those aspects out and properly maintain those items. It's going to directly correlate to the financial. Yes, sir. Go ahead.
Yeah, I'm sorry to interrupt, but I just want to emphasize something. When you talk about generally accepted accounting practices, I know that no matter what system we are using, when we get funding from foundations or funding from the government, they pretty much insist on generally accepted accounting practices. So what I hear you saying is that the dual or double entry bookkeeping is the standard, right?
It is the foundation of that standard, absolutely. And the reason for that is there are other methods of bookkeeping. So there's single entry bookkeeping. Most of us would recognize that, like trying to balance our old checkbook ledgers that we had that the banks used to give us prior to digital banking and those types of things. But since 1495, quite frankly, the industry standard has been dual entry or double entry bookkeeping, and US GAAP and IFRS both require the use and deployment of double entry bookkeeping. And that primarily correlates. You'll see what happens is without double entry bookkeeping, we wouldn't be able to record transactions to the balance sheet on an operational basis. So really what that would dramatically affect our ability to accurately get a financial picture of the organization's health, because it would be working very similar to our checkbook ledger, and provide very minimal detail without that double entry process.
So since most of our participants are not accountants, or maybe none of our participants are accountants, I guess what I'm hoping you'll share with us is how we as non-accountants can look at what we're getting from our bookkeepers to make sure it is this generally accepted accounting practice.
Absolutely. The other aspect, and I've got 4 examples that I'm going to cover in this presentation that will specifically kind of show you the nuts and bolts of what's happening in the double entry process. Another aspect that you need to keep in mind is that double entry bookkeeping, the fundamentals of that double entry bookkeeping process, it creates that balancing effect, because different account types, whether we're talking about assets or liabilities or revenue or expenses of the organization, you have to understand how your posting of those transactions is going to affect the normal account balances through that recording process. But at the end of the day, the process of double entry bookkeeping is a self-balancing process. So as long as your balances at the end of the day are equal, then your bookkeeper has done their job correctly, at least recording to the account types. And I'm going to be going into that a little bit further. Now, whether they've recorded to the correct account within that specific account type, that's up to the strategic and the management process for the accountants and the management to review. But as long as the bookkeeper has recorded it to the proper account type, then it will balance and the accounting process has been done appropriately. If it's not in balance, then we automatically know something's wrong, and that gives us a start of where to go in and start diagnosing where the transactions have been recorded incorrectly. The last bullet here, actually, I indicate there that, you know, an accountant or an analyst that understands accounting well can use the chart of accounts as a very effective diagnostic tool to understand where problems are occurring, either in the accounting function or in the operational function of the organization. Thank you for bringing that up, Mark. So as I've previously stated, the chart of accounts begins with the designation of an account name. So usually you're going to want to identify, like specifically if we're talking about revenue types, and if we're in the business of agriculture, perhaps we want to identify, you know, specific products or specific categories of products, whether we're talking about meat, vegetables, grain, or value-added products, processing, those types of things. So you want to make sure that the name is indicative of what the activity is. And it needs to be something that's concise and clear, and quite frankly, is something that is obvious, so that when the bookkeeper is recording a transaction, if they're having to decipher, you know, where would this specific transaction be appropriately recorded, the account name should really kind of clue them into what that is. In combination with the account name, we would also include the account number. The account number is a very important process of sequencing for a number of reasons. Regardless of size, whether we're dealing with small or large organizations, the sequencing of the numbers is going to directly correlate to where those accounts will show up on the financial reports. Again, that's something I'm going to cover here when we get into financial reporting. But aside from the sequencing, it also allows you to grow, expand, or contract the organization as the organization expands and contracts. And that sequencing process allows you to keep the chart of accounts as well as the history of the organization clean if it's done properly. For smaller organizations, usually a 3-digit numbering system is sufficient. For larger organizations, 4-digit numbering system may be appropriate. And if we're getting up into organizations like Disney or Amazon, some of those very large scale global organizations, you'll see that their number sequencing can be 5, sometimes 6 digits, depending on the account type and how much detail the management wants out of the financial reporting process. One other thing to note with the chart of accounts design process is that management has the option to design a parent-child relationship with the chart of accounts. Now, what this does, or the benefit of this, is this provides or facilitates a summary versus a detailed reporting aspect. So your senior executives, they may not want to get down into the nitty-gritties of each revenue line item or each cost and expenditure line item. So when we structure the chart of accounts under a parent-child structure, we're able to provide summary reports of total revenue or total expenses to senior management. But then we can equally go in and bring down the detailed reporting for individual departments or managers of those departments that are wanting to look at and address specific items within the detailed report. So here I wanted to kind of pictorially show what it was that I was talking about with the chart of accounts. On the right-hand side of the screen, you'll see, this is actually an excerpt from one of my clients that has a cooperatively structured insurance agency. And so you can see that on the top portion, the account type is the revenue accounts. And we've broken down by code, which is a 3-digit number, the revenue accounts. Usually I'll reserve the 400 series for revenue. If you look at the little chart on the left-hand side of the screen, you'll see I've identified the types of accounts that exist within the accounting system, and those are the assets, liabilities, equity, revenue, COGS, or the cost of goods sold, and then your expenses. And then the numbering sequences that are commonly found tied to each of those account types. And then I also felt it was important to help you understand, if you're not already, where those account types will show up on the specific financial statements. So your assets, your liabilities, and equity, they're all going to show up on your balance sheet. And then the 3 other will show up on your income statement, also known as a profit and loss statement. When I was referring to the expansion, or at least creating space within your numbering sequence for the options of expansion, what you'll see is if you look at how I've kind of sequenced these numbers for this specific client, I've left room, usually here, let's see, I think if you can see my cursor here, between 420 and 430, there's approximately 9 accounts that I have the ability to expand on. So if, for instance, there's separate home policies that this particular insurance agent might start offering, and she wanted to track the different home insurance policy types, then I would have the ability to expand that specific portion and create a parent-child relationship with accounts 420 to 429, and give her that ability to have that level of detail reported for each of those specific policies. So at the end of the day, all I'm referring to is just try to be strategic about your planning of the account names and the account number sequencing to allow for your ambitions for the organization as it grows or as it contracts. Then you can make use of those number sequences to benefit you. The last thing I want to point out on this specific slide, if you'll pay attention to how the account numbering sequence for the COGS is identical to the account number sequence for the revenues. It's just using the 5-digit instead of the 4-digit sequence. I'm the 500 series instead of the 400 series. What this will allow for when you're reporting, if you structure your accounts this way, is a quick and easy facilitation of monitoring your profitability for your specific revenue centers. So for example, here we've identified our Medicare supplement income under account 405. And anytime there are direct costs, whether that's direct labor or materials that would be necessary to generate that revenue under 405, it gets booked to 505. And so what I'm able to provide this client by structuring it this way is an immediate evaluation of the profitability for Medicare supplement income. if we consistently see that the direct cost for line item 505 exceeds the revenue that's being generated for line item 405, then the manager, or in this case, the business owner, is quickly able to decipher that this is not a profitable activity for the company, and they need to either look at their pricing structure, they need to look at the cost structure, or they need to make the determination to get rid of that revenue center, because ultimately it's costing the company money. So sequencing, there's a number of strategies that are important to keep in mind when you're going through your chart of accounts and designing your sequencing, specifically on your COGS and your revenue. It's get as close as you can to tying your cost, your direct cost, to the revenue activity, so that yourself and or management can quickly determine how profitable is this activity, and is it something we should keep doing, or are there changes that need to be made to our process. So what is the dual and double entry bookkeeping process? It was popularized, it wasn't designed or developed, but it was popularized by Italian maestro Luca Piccioli back in 1495. And it did revolutionize the accounting industry. Without it, as I've previously stated, we'd be able to get very little detail and, quite frankly, very little accuracy out of the accounting process if we were using single entry bookkeeping methods. And so this is why the industry has widely adapted. And now your two major regulating bodies that regulate the accounting and finance industry require the use of double and dual entry bookkeeping. Any questions so far?
So people have been using this since 1495? Since
1495, yeah, and it was even tested for about 40 years prior to Luca Piccioli actually, writing he wrote a series of 3 different papers and published those papers, making the argument for why the industry needs to move to this. And it was about a 40-year debate before they fully adopted it, but it's been around for that long. So it's a well-tested theory. So really the complexity of double entry bookkeeping, this is, honestly, I went through 8 years of school for accounting, right, to reach the level of understanding of accounting that I have finally achieved. And quite frankly, it wasn't even after I finished my master's program and I had a 2-hour conversation with a banker before all of it finally started to make sense. But the complexity of accounting can really be summarized on this chart here. So accounting is a process of using debits and credits. Most of our understanding, and by our, I'm meaning the layperson, the person who is not a acting professional accountant on a day-to-day basis, who is working with debit and credits in the sense of accounting, probably has a different understanding of what a debit and credit is. Most of us who are primarily operating out of a checkbook probably think of a debit as something that decreases and a credit that's something that increases our balances. However, in the world of accounting, that's all determined by the account that we're actually working on and the normal balance that type of account carries. So this table here will help you understand the normal balance of the 6 types of accounts that we use and the ways that we can increase or decrease those balances. Make sense? Okay. So the main thing to understand is that debits and credits, they're not set. Debits aren't set as a decrease and credits aren't set as an increase. It depends on what account you're influencing. So as an example, for the dual or the double entry bookkeeping process, example 1, let's look at what does it look like if we sell goods from inventory on account. So if we are an agriculture producer, let's say that we have a contract to sell $1,500 worth of product. What does it look like to record that transaction? And also for this scenario, we're going to assume that no cash has been exchanged, that the business sold the product on account. And this is going to give us a look at a couple of different ways that we have to enter this transaction. So we sell the items in inventory on account to a buyer. There's going to be required 2 entries in this situation. The first is a debit to the accounts receivable. So we want to make sure that we record that someone owes us money, and we're going to record that into an accounts receivable account. And that'll be for $1,500. And then we're going to record the credit to revenue. Even though I stated we didn't receive cash, I'm indicating here that we're going to be recording this to revenue. Can somebody help me understand why?
Otherwise they wouldn't match up.
Yes, but why would we record it to revenue? I said there was no cash exchange. That was just a promissory note, right? The customer agrees to pay us $1,500 at some point. So there was no cash exchange. We gave them inventory goods in exchange for their promise to pay in a future note. So why would I record this to revenue? The reason is revenue is different from cash. So this is an important distinction in the world of accounting. The revenue account is specifically relating to the sale or the transaction. The cash account is going to tie to an asset account, which will show up on the balance sheet. And the easiest way to think of it is just your bank accounts, right? So any of the accounts, if you have a bank account, the business account, the primary operating account, that's where the cash transaction will actually be recorded once the cash comes in. But for the time being, we use the revenue account. It's strictly a sales account. So we're going to use the transaction to record the sale has occurred, and the offsetting transaction or the balancing transaction goes to accounts receivable to demonstrate that someone still owes us that $1,500. Once that $1,500 is actually received from the customer, then we would post a credit to the accounts receivable for the $1,500, which would clear that account receivable. And then we would post the debit to the cash account. If we go back to our previous slide, we can see that under our assets, where our cash account would be, a debit would increase the account, correct? And so that would record the $1,500 receipt of cash to our cash account, which would be in our assets. Is everyone clear on that so far? Okay, I know this is super fun stuff. The subsequent transaction that we're going to record in this specific instance is to record the cost that we, the organization, have incurred for this transaction, right? So we've recorded the transaction itself. We've deducted the amount, or we've increased the amount of accounts receivable to indicate the promissory note has been issued, and we've recorded the sale for the $1,500. Now what we want to do is we want to make sure that we reduce our inventory balance to show that the inventory has left our possession. And then once inventory leaves the inventory accounts, we have to record the cost somewhere, because there was a cost for the company to either procure or manufacture those inventory items. And so we need to record that cost somewhere. That's where our COGS come in. The COGS, or the cost of goods sold, are the direct materials and labor that is used to generate revenue. So in the case of this specific example, we're going to record $1,000, where the $1,000 was just a made up number for the purpose of the scenario. We're just assuming that the cost was $1,000. And then we would record that to COGS under a debit transaction. The subsequent, or the balancing transaction, would go to inventory to reduce inventory by that $1,000. The net difference between the 1,500 and the 1,000 will automatically carry down the balance sheet on the profit and loss to show a profit of $500 at the end of the day. So we don't have to do a separate transaction to record the profit.
So I have a question.
Go ahead.
This might be basic to the people here, I'm not sure, but as an agricultural producer, how would you determine your COGS for a product? Let's say winter squash, you know? Like
Yeah,
how do you do?
So you have to start with, and it depends on the level of detail that management of that specific producer really wants to get down to. Obviously, if it's me involved, I'm going to get pretty stingy given my accounting background, because I find the value in the data. So I want to know time and motion studies. So what I'm going to do is I'm going to set a baseline of how many man or woman hours is required for the preparation of the grow beds, the planting, grow out and maintaining, weeding, watering, all of the requirements that are necessary to bring that product to being ready to harvest. I'm going to allocate the time that's required to harvest. And then I would add in any seed cost, water cost, if there's equipment costs, such as renting equipment for harvesting or tilling, those types of things, then you would basically designate out a portion, right? So if we've planted 2 acres of squash, then we're going to divide the cost of that equipment across the entire 2 acres of product. And then each product would have its proportionate share of that overall cost. So it comes down to identifying total labor and then the total materials that went into it. And then we break that down. You know, if you've harvested 300 pounds of squash by the end of this, then you would basically divide your material costs by the 300 pounds. And then each pound of squash would be assigned that proportionate share of the cost that would go into COGS. You know, so if you sell 10 pounds of squash, then the proportionate share of the 10 pounds of the cost would be booked to COGS and reduced from inventory. Does that make sense? Most people, especially agriculture producers, in my experience, are not going to get down to that level of detail because they don't have the infrastructure and the manpower in the back office usually to do that. But if you really wanted to get down to the appropriate way and the data way to do this, then that would be what my recommendation would be. Does that help? For those producers who don't necessarily have the resources to enact this type of level of detail, then what I would suggest is that we can usually guesstimate or provide an estimation of cost across the activity, and you just use those assumptions as an assignment of cost. And that's usually sufficient for smaller producers. Over time, you refine the formulas that you've used to come up with those assumptions. And I find that that's usually sufficient for working with smaller producers that don't have a strong or a big data team behind them.
So it's like a process. Every year you hone it a little bit more.
Yep.
And hopefully it keeps getting better. Okay.
Yep. And over time it does. It usually, you'll find over time you can get pretty accurate without having to spend hundreds of hours diving into, you know, really strict detail. Okay. So the second example, now that we've sold the inventory from example 1, let's take a look at what it means to replace that inventory. So in example 2, we're going to purchase the inventory to replace what was previously sold. We're going to buy another $1,000 worth of inventory goods, and we're going to place that back in inventory. In this particular transaction, we're going to go ahead and use our own cash rather than purchasing the goods on account. So in this case, we're going to record the increase to our inventory balance by the $1,000, and then we're going to decrease our cash with a $1,000 credit to show that we reduce cash to purchase that $1,000 worth of inventory. Does that make sense? Okay. Moving on to example 3. So now we've gone through our first 2 examples, and we've decided, you know what, I think instead of trying to dig or set these grow beds by hand, we want to start looking at a piece of machinery that can handle setting up our rows for us. And so we've decided that we're going to go ahead and we're going to purchase a piece of equipment. We have entered into negotiations and been able to negotiate a price of $4,000 for this specific piece of equipment. So the way this transaction would be recorded, if we are going to purchase this piece of machinery on account or on credit, it would be booked to accounts payable. Now you can establish your accounts payables accounts with your suppliers or your vendors if that's the way, if your suppliers or vendors have a credit process or a credit purchase process. But you would also establish accounts payables for things like credit card accounts or revolving loan accounts if you have a revolving loan or line of credit from the bank. But in any of those types of accounts would apply to an account payable. In this specific purpose or this specific example, we're just using our vendor's accounts payable or credit process. So we've signed the contract, we purchased the piece of equipment for $4,000. We're going to increase our asset base for the organization by the $4,000 because we've added that piece of equipment for the $4,000. And then we're going to also record the balancing transaction to our liabilities, where accounts payable will fall. And that way we've indicated that we still owe the $4,000 on the balance sheet. And from a math perspective, we would be able to see that the $4,000 asset is decreased by the $4,000 liability. So there's no net change to the equity of the organization. Okay, does that make sense? And that's an important distinction to understand why the double entry bookkeeping process is so important. Without it, if I had only recorded the purchase of the $4,000 piece of equipment and didn't have that offsetting transaction of the credit note, then I would be able to misconstrue the actual financial health of the organization because I don't have that offsetting transaction to show that there's actually a liability that's posted against that $4,000 asset that the company now owns. Make sense? Okay.
So if for a piece of equipment though, if they depreciate over time, do you have to consider that or?
Yes, and now we're getting into more complex accounting and
Sorry.
theories, right? So because there's so many different theories around the discussion of depreciation, but you're absolutely correct. The law does provide us the ability to depreciate the asset. That process, it only affects the tax liability of the organization. Okay, so you are absolutely correct. I just chose to leave that out for this for the purpose of the example, keeping it kind of simple. All right, and then our last example, I think we've kind of hit this home, but I wanted to demonstrate that in the world of double entry bookkeeping, the minimum is 2 transactions for every transaction. So every activity, every transaction that occurs within an organization, there is a requirement for a minimum of 2. But that does not mean that there can't be more. So in our 4th example, I wanted to demonstrate that by a common or typical payroll example. So we've gone through, we've sold some inventory, we replaced the inventory, and then we bought a piece of equipment. And now what we're going to do is we're going to go ahead and process payroll. So here what I've done is I've shown how each person who we are paying can be broken down into their own expense account that would show up on our profit and loss statement. And what this would allow me to do is track the expense that specific employee represents to the organization over the life of that employee. There are a number of different ways that you can structure this, depending upon the detail that you wanted in the organization. But for this specific example, we've gone ahead and we've broken it out per person, per line item. And then I've also shown, after we've paid the 4 employees their salary for that specific payroll period, I've booked the payroll tax expense to demonstrate that we've paid the payroll tax for that specific payroll period. And then the entire transaction is balanced on the credit side by the cash that was used from our business operating account to pay not only the payroll expenses, but also the payroll taxes and the employer's portion of the payroll taxes. So now you're able to see through this example that you can have more than 2 transactions in the double entry process, but it needs to balance on both sides. Does that make sense? Okay. All right. Well, that's rough. Those two functions from a foundational standpoint are probably the key aspects that management needs to understand, because the decisions that they make are going to greatly influence how the accountants or the bookkeepers are going to record the transactions in the chart of accounts using the double entry bookkeeping process to provide you, management, the data back that you're going to be using to make decisions. When it's all said and done, at the end of the day or at the end of the accounting period, depending upon how often it's done, what happens is those transactions that we just observed in our 4 examples are going to roll up to the general ledger. The general ledger, the easiest way to look at it, quite frankly, is it's like a checkbook ledger, except that it's going to be for every account that is listed in the chart of accounts. So if you imagine that each account in the chart of accounts, and I've honestly seen some bookkeepers do it this way, they have, excuse me, they have a separate checkbook ledger for every account in the chart of accounts, and then they use that to record the transactions, keeping track of the debit and the credit side, and then the ending balance. Modern accounting systems, this is all done behind the scenes. It's nothing that even, quite frankly, the most sophisticated of bookkeepers or accountants has to even touch anymore, because accounting systems handle all of these functional processes behind the scenes at the end of the day. Posting entries in the general ledger, they should be labeled with the name of the account. So if you're a smaller organization and starting with, say, an Excel spreadsheet, I wanted to provide you with some of the minimum details that you'll want to provide in the general ledger. entries, just to make sure that you're meeting not only audit requirements, but can reference the transactions at a later point in time. So we're going to do the date of the transaction. We're going to do a description of the transaction. We're going to provide a reference number. And what I mean by that is, in example 4, if this was one transaction that we were posting on the daily ledger, it would have a reference number, usually some nomenclature that would be done by date, and maybe the sequence number of the transaction of that date, right? So if this was the 30th transaction that I was posting for today, then I would use today's date and the number 30 as a nomenclature reference that I'm indicating here, so that once I roll it back to the general ledger, I'm able to reference the daily ledger that was the source of these transactions, and then I can go back and get the detail specific that I needed. You're going to need to make sure that you include the dollar value entered as a debit or credit, and then the account balance, the ending account balance after you posted that transaction. And that's the role of the general ledger. So we've used the chart of accounts and the dual entry process to create a transaction ledger. And we'll just, for the purpose of this example, we'll say that was a daily transaction ledger. At the end of the day, because we're super efficient and good accountants, we roll that into the general ledger. We're going to use each of these 5 different pieces of information from the daily ledger to include on the general ledger. And then the general ledger is what is used to create the financial reports at the end of the accounting period. Go ahead, Mark.
Yeah, so you said that most accounting systems transfer this to the general ledger automatically, right?
Yes, they do.
So would that include simple programs like our group is most likely to use, like QuickBooks or something like that?
Yes, QuickBooks, Xero, Peachtree, Desktop Accountant, all of the modern accounting systems, they handle this automated behind the scenes. So it's very simple.
So when we are dealing with, and like I said, most of our participants probably are, going to manage budgets, but they'll have somebody who's knowledgeable in accounting to do this. When we would ask an accountant who's working with us to give us a general ledger report, they should be able to generate that right away, right?
Immediately, yes.
Mm-hmm. Okay.
Yeah. If an accountant can't produce the general ledger on a moment's notice, then what that should show you is that they're not doing their job, for one, and that your reconciliations have not done properly. Because the reconciliation process requires the accountant to not only validate the transactions coming into, like, your checking account or your primary operating account, but they have to follow that all the way through to the general ledger to make sure that the general ledger balances match identically to what the bank statement balances match to.
Mm-hmm. Okay. Thank you.
Any other questions on the general ledger? Okay. When you provide your taxes, your tax information to your CPA or your accountant at the end of the year, they should be asking you for a copy of the general ledger from the accounting system. So just keep that in mind. If they aren't asking for that, then that should tell you that they are not validating that the reconciliations have been done before they're processing your tax information or your tax numbers to generate either a tax liability or what the IRS is going to owe you back. So that should be a red flag for you if a CPA or a tax professional is not asking for the general ledger as a part of the package of documents that they're asking for. Then they're not doing the validation that I would consider to be important prior to processing and finalizing your taxes. Okay, how's everyone doing? I know this is such super exciting, fun information. Go ahead.
It is. So back up to the double entry. So that's just based on debit and credit, right?
Yeah, it's all based on debits and credits, and debits and credits are an accountant's magic trick, quite frankly, in how we influence the account balances based on the transactions.
Awesome. And it seems like what you said, we use the wave accounting system, and it seems like a lot of that gets done for us behind the scenes, like you said.
Yeah, I mean, the cost with modern accounting systems, I know Xero, you can get into just a basic general ledger type of contract with like Xero or QuickBooks for, I think it's $11 a month is their current rate, which would allows you to record transactions just like we have in our examples, and it will maintain the general ledger for you and provide basic financial reporting. So I understand the desire and the most people's insistence to move over to Excel because there is no cost involved. But quite frankly, with modern accounting systems and the relatively low cost that they have, those modern accounting systems, they do a lot of the behind the scenes work that frees you up to focus on other aspects of the business. Thank you, Tyron. That was Tyrone, correct?
Yes, thank you.
Yeah, thank you. Okay, before we go into financial reporting, any other questions on? And as far as the group is concerned, is this helpful? Is this too deep? Does this help provide the information that you would want to know to help prepare your organization to handle the issues of accounting and bookkeeping for your organization?
Well, just speaking for myself, Kevin, I would say, as long as what you're teaching us, which I think is what you're teaching us, that we know what to look for when it comes to the accounting reports that we're getting, then, you know, we can, this is very helpful to be on top of the reports, to know when we're getting what we need and when we're not getting what we need.
Yeah, thanks. I agree. From my perspective, the simplest way to reduce the anxieties that come from looking at financial statements, if you can understand what's generating the information on those financial statements, then even if you don't understand or want to understand the accounting process, at least you in a management position or position of making decisions can understand where the information is being sourced from on these financial statements. And if you're not finding the information useful on these statements, then quite frankly, you as the manager, it's your responsibility to come back and understand that the basics of these financial reports is being generated from the chart of accounts. If that's all you take away from today's presentation, then I feel like I've done a good job. Because then you can at least know to go back and ask your accountant bookkeeper, show me my chart of accounts. And then you can strategically sit down and look at how have those chart of accounts been designed? What changes do you want to make? What level of detail do you want to see in order to make those decisions that you're needing to make, given your role and responsibility in the organization?
If I can just add a comment too, I have a very limited background in accounting, but I think when you initially encounter these systems, they seem really daunting, but once you get into it, there's an ebb and flow to it, and it's much easier to navigate once you're in that system. So
yeah, thank you for that. And that's really my goal, is to try and take what has, quite frankly, it's overcomplicated by design, and I don't agree with that. And so I really try hard to try and peel back all those complex layers to help just give you the basic, like this is all it is, all the fluff and everything, the bells and whistles that the accountants have attached to their processes and their accounting systems over time. They're just that, they're bells and whistles. The basics of what I'm showing you, the chart of accounts, and you in a management position, if you can understand that the transactions are being recorded to those chart of accounts, and those chart of accounts are being used to create the financial statements. Once you fully grasp that, then it should be easy enough for you to understand how to make the decisions based on what's being reported, or to decipher if something doesn't look right and how to go back to, you know, the accountant or the bookkeeper to request fixes to be made. All right. This is the magic for me. You know, I mentioned earlier, I spent the better part of 20 years studying finance and accounting, trying to understand the realm of money and how money moves and what does it mean. And for this portion of the presentation, what I'd like to do is kind of dispel some of the myths around financial statements and the actual information they provide. And if nothing more, I just want to give you a different way of looking at these financial statements so that as you're going through and building your organization, you're able to tie and correlate when you make a decision, 3 months away, and then you get your quarterly statement, your quarterly financial statements from your accountant, or you're finally getting around to evaluating the financials. You can start to tie out how the decisions you're making translate to the financials. And if I can help you understand that, then maybe I can help you kind of forecast how to make better informed or better data-driven decisions to drive to where you want to go, so that you're not having to try and make those decisions in the dark or without good information. The easiest financial statement to begin with, and what I think most people are comfortable with, is the profit and loss statement. It's also known as an income statement. And what I've done here is I've kind of broken down the statement into the primary categories. On the top of the statement, you'll see the revenues. If you have a good accountant, they will break down each line item of revenue that is applicable to your organization. Going back to our previous statement on the chart of accounts, the reason this is important is because if you look below the revenue line items, you'll see that I've also broken out the COGS line items, or the cost of goods sold. If you remember that the cost of goods sold, the definition of a COG is a direct material or direct labor that is required to generate the revenue. This is an area when I usually take on new clients, this is an area that is, quite frankly, it's a pain point for me that most accountants aren't as particular about this as I am. For that specific reason, if I'm not tracking the costs that are directly tied to the revenue for that specific revenue line item, then it becomes quite an exercise for me to dive in and start to understand, should I be growing squash this year? Should I be raising and harvesting chickens? Like what areas am I spending my time? And is this a profitable area for me to spend my time in? And so when it comes to setting up an organization from the very beginning, the first thing I want to do is be able to show them whether the product or service model that they've designed and developed is a profitable one. Because if we can't create a profitable product or service, then we have no business developing the rest of the business or the business overhead model, right? So the top portion of the profit and loss statement, beginning with the revenue and then moving down into our cost of goods, once we subtract those costs from our revenue, that will give us our gross profit. That specific calculation there, that is our product or service model. If we have succeeded in properly pricing our products and our revenue, if we have succeeded in effectively controlling the direct materials and direct labor that are required to generate that revenue, then we have successfully come to the business model, at least, with a profitable product or service. And at that point, we should appropriately move forward into developing a business structure model, which is how we bring that product or service to market. Okay. So moving down below, go ahead.
Right. So doing the work to identify your COGS and everything for every product, does that happen when you're doing your business plan, or like, is there a set point where you should have that all set?
So when you're doing your feasibility plan, yes, that is part that's usually included, although I would say it's probably not to the level of detail that I'm talking about here. This is a continual process. So because when you're actually in the real world, things are constantly changing. Pricing is changing. Hopefully it's changing. Many businesses fail to understand the importance of changing their pricing to keep up with inflation. So costs are changing, pricing is changing. There's many different moving targets that are occurring within the marketplace all throughout the accounting period. And so businesses should be tracking and maintaining clear visual, which is why I'm so adamant about making sure that my direct material, my direct labor costs are directly and easily identifiable to the revenue that they generate, so that I can provide decision support to those business leaders to understand this specific revenue activity is either doing its job or it's costing you money, and you need to take action here, whether that's making pricing changes, addressing cost structures, or completely getting rid of the activity if neither of those things will fix the problem.
I have a question.
Yes, sir.
Yeah, so looking at those costs of doing business, thinking particularly of the gas prices going up right now. And they're going up weekly. So how often do you go back and revise this? I mean, do you project forward, or do you just go with what is right now in terms of the costs of business?
Yeah, so that's a great question. Because from a practical application standpoint, how quick is this? Can this be adjusted, or can we take action on, right?
Mm-hmm.
The direct cost that we're experiencing right now, you're going to experience that in these financial statements immediately. Once the transaction occurs, especially if you're using a modern accounting system, pretty much every accounting system will pull your bank feeds at midnight, and it would pull that transaction in. So if you took the fuel can down to the gas station and filled it up with 10 gallons of diesel, at midnight, that transaction, if it was purchased through a bank account, is going to come into the accounting system, and then the accountant's going to reconcile that transaction, and that's going to immediately flow to the proper line item as long as the accountant has done their job appropriately and identified that specific cost to that direct COGS. So at that point, management has that information to start that decision-making process, right? So they can at least immediately take action on, this is what has occurred. And then if they need to adjust the budgets or the forecast, given that new information, then we can go in and make those adjustments for that forward-looking strategic analysis. Does that answer the question?
Well, it does, except in the real practice, at least in our organization, we use credit cards a lot. Business credit cards. So you don't get the credit card statement until weeks after the actual purchase sometimes. But I guess the answer is, you still, once you have the credit card statement and you put it in, then you know where you're standing. But it does seem like our inflation and especially gas prices are changing so quickly. It's hard to keep up with it. So I guess we just have to estimate what we think the potential cost would be. And I'm thinking of farmers adjusting their price on what they're selling, based somewhat on how much it costs to get gas to bring out water and water their fields, you know, as an example.
And I agree. So if I mean, farmers especially are susceptible to fuel and water costs, and they should already have at least baseline numbers that they're using to assign costs. So, you know, for instance, let's say they were basing costs off $3 a gallon to assign those direct costs for their accounting process, but now we're up to, let's say, $6 a gallon. Even for smaller agriculture producers, they should be able to adjust and quickly with those changed assumptions, or the changed assumed costs, even if we don't have the actual cost in real time just yet.
Mm-hmm. Okay.
I agree. You know, I've worked with a lot of clients in the past who just don't understand the importance of that, whether they're landscape companies or agriculture producers, but they're not paying attention to how to assign those costs in their bid process or their forecasting process to make sure that they've established proper pricing to include those new costs that are coming in. And that's just where it's really important to have an accountant that understands how to do that process and make sure that they're a part and included in that, so that the agriculture producer isn't missing out on covering those costs with price changes and those types of things. So is everyone pretty comfortable with the concept that the top portion of this financial statement The only thing it tells you is, have you successfully developed a product or service that can be brought to market in a profitable manner, right? That's the only thing we're really trying to use the top portion of this financial statement to help us understand. If we've been successful in developing a profitable product or service, then at that point it is appropriate for management to begin the process of identifying the business structure model. And that is the overhead expenses that we assign to the business in order to bring that product or service to market. And that may look like buildings, it may look like vehicles and trailers with cold storage if we're handling products and bringing it to a CSA or a farmer's market. But the business structure model, those are the costs that we are going to realize in order to bring that product or service to market. One reason accountants love what they do is because they can pretty much get rid of that bottom portion, except for an office space if they hold an office space, and maybe a few overhead expenses. But generally speaking, certain types of businesses will have smaller business structure models, where others will be more intense in that specific area. But the key point being is, when you're looking at your profit and loss statement, I implore you to look at it from these two different lenses. The first is, have I been successful in developing a profitable product or service? Or do I have work to do in addressing the pricing and or the costs that are involved with that aspect? And then second to that, have I been successful in developing a business structure model in order to bring my product or service to market? And that will be encompassed in the bottom portion of this statement, before net profit. There's two types of costs that you're going to see in your overhead costs in that bottom portion, and those are what we call variable and fixed costs. Again, here's just an overcomplication of something that's quite simple. Your variable costs, all that simply means is that if the cost varies as revenue increases or decreases, it is a variable cost. Some labor might be an example of that. So if you have an increasing sales trend, and that trend then translates into, I need more hourly employees. Hourly is a key term, not salary, because salary is going to represent a fixed cost. But if you have hourly employees and you're now requiring more hourly labor to satisfy or meet the demands of increasing sales, that would be a variable cost. Fixed costs are going to typically be like your rent or your mortgage, insurance payments, as long as they don't fluctuate based on your revenue, volume of revenue. So that's just breaking down those two different types of costs that you're going to realize in your overhead expenses. And it's strictly around the business structure model that you're using to bring your product or service to market. At the end of the day, when we subtract our overhead expenses from our gross profit, we arrive at the net profit, and hopefully we've done our jobs well. And that's a positive number that we will then make a determination on what we're going to do with that money. Any questions on the P&L or the income statement so far?
Right now, JG Farms is going to be kind of overheading the co-op as far as buying produce from the farmers and then finding the market. While compiling that data, can we just move it over to another account as the co-op evolves?
Yes, but will you clarify what you mean by moving it over to another account for me? I think I understand. I just want to make sure I'm clear on what you're asking.
Just the data for the most part. So JG Farms is in the business of building hoop houses, and that's our product and service. But again, we want to start purchasing produce from our producers because not all of them want to market, or not all of them want to be at the farmer's market. And so to alleviate that, we'll just buy the produce and find the market for them. And eventually we want to have the co-op do that, but they're not in the position as of now to take on those challenges.
Okay. So yeah, I think to answer your question, absolutely, you would create a separate revenue account. In your case, we might call revenue line item 1 revenues that are generated from hoop house building or installation. And then revenue 2 would be revenue that's generated from produce sales. And then we would track, under COGS 1, any of your costs for the materials from the hoop house and the labor to install a hoop house would go under COGS 1. And then any of the material and or labor that's involved with procuring the produce would go under COGS 2. Does that answer the question?
Yes.
Okay. And I'll just let you know, once you get into produce buying, when I was at Sprouts Farmers Market, our pricing team, and I understand this is a very large grocery retail. At the time, there was over 300 stores when I was there. But our pricing team consisted of over 60 analysts, and their sole job was to basically compile data, the receipts from our produce buyers when they would go out and they would buy produce or product, all the way through to conducting market trends for wherever that product would be sold. So if it was in a California market, obviously it was going to probably have a higher retail price than it would have in an Arizona market, given the costs and the economic factors that are going to influence that pricing. So that's something that you guys are going to want to keep in mind as well. I understand that is a very demanding structure to have for a small startup cooperative. But just bear in mind the importance of having a strategy in place for dealing with the pricing of that product and making sure that it's going to meet and satisfy your costs.
Absolutely. And I think that's where the Change Labs team comes in and has been really influential in helping us.
That's fantastic. And I actually, we can do it in an offline conversation, but I'd be interested to hear more about that team and specifically what they're working on.
Awesome. We'll connect you.
Great. Okay. Any other questions on this statement?
Well, I hope this isn't too far off track, but you said you had worked with a number of tribes, including the Maoris in New Zealand. And so one of the things I'm thinking of is this establishment of costs of doing business is something that tribes probably are not very well versed in. And I just wanted to know, has that been your observation?
Yes, but I want to preface that with, quite frankly, I'm learning a lot about the nature of business from a lot of the indigenous communities in the South Pacific, whether that's the Maori tribes in New Zealand, some of the Aboriginal tribes in Australia, the Fijians and the Vanuatus, the Nivans. You can't, the way we do business here in the Western world is so different because everything is tied directly to capital. But in other parts of the world, especially with agriculture production, whether we're talking about taro root or cocoa or coffee, I mean, they really exercise what we in the accounting industry call good faith negotiation, where it's not always a one-for-one exchange of capital for the inventory. There's other factors that we have to take into consideration as a part of that cost and pricing structure. And quite frankly, that just falls outside of US GAAP or IFRS. So in what you're referring to, what I'm grateful for with this education that I'm receiving is that I see that what's happening in the US economy and in the Western world in general is there's going to be a greater shift to what some of this local wisdom or this indigenous wisdom is already practicing in their businesses. And how we as accountants are going to have to classify those costs and keep track of that good faith business being conducted is pretty awesome, but it's shifting our understanding of how business is conducted.
Great, thanks.
So the profit and loss statement, at the end of the day, it tells us two things. It tells us, have we developed and designed a profitable product or service, and have we designed a business model that is profitable to bring that product or service to market. That's it. That's as complicated and as complex as you need to make it. And if you can get your accountant to set up set up your financial statements under this method using the chart of accounts appropriately, then I think you will find that you have a much easier time deciphering the information you need in order to make intelligible business decisions. Moving on to the ever so dreaded, oh, actually, I guess I did have one other thing. You know, one thing I do hear a lot from a lot of business owners is that we're just going to make it up with volume, right? And quite frankly, if you look at a number of different organizations operating in today's business world, and probably for the last 20 or 30 years, you will see a greater drive in the making it up with volume rather than appropriately addressing pricing and or cost control vehicles, because making it up with volume is easy, right? It's an easy pass. It's convenient for management to make that excuse of, well, costs, you know, fuel costs are rising, labor costs are rising. There's so many different influences, internal and external factors that are influencing these things. So we can't really compete by doing the things we're supposed to be doing. So we're going to make it up with volume. There's a whole philosophical conversation that I won't really dive into around capitalism and why capitalism is a flawed system, because making it up with volume ends up in any capitalist system being the only end result until that no longer works as well. And quite frankly, I think that's what we're starting to experience the start of. But from your perspectives of developing and designing a strong, well-performing, properly functioning business, making it up with volume is not a strategy, at least not a sound strategy, nor is a strategy that I would encourage you to look at. You need to really look at a per cost item. And if you can't produce that item on a profitable basis, then you'd probably need to look at other activities, or as I had mentioned, that is already being done in other parts of the world. They are finding ways to assign different values and costs to things in order to make their businesses work just under different rules. So I'll step off my soapbox for that and move on to our balance sheet. This is by far, from my experience, the scariest financial statement in all of finance for most people. And hopefully here by the end of this, I'll be able to help you understand what's really happening so that it doesn't have to be quite a daunting financial statement. The balance sheet comprises our assets, what the business owns or has at its resource disposal. Below that is the liabilities, what the business owes to debtors, whether that be short-term or long-term. And then at the very end, we subtract our liabilities from our assets, which also happens to be the accounting equation. Liabilities minus assets equals equity. And that's how we know what our value of our organization is worth. Within the equity section, you'll see that there are a couple of different line items. You have usually a designation of accounts that's going to identify the shares of the company. With a cooperative, as you can imagine, this particular portion of the financial statement can get quite complex quite quickly because we have many different shareholders, all owning either a single membership share that gives them the voting rights within the organization. And if the organization or the cooperative has done a subsequent capital raise, then there may be subsequent equity shares that are also assigned with non-voting rights. And so that's where you'll start to see the complexity grow on this specific financial statement, depending upon the activities and the financial raising, the capital raising strategies of the organization. But in any scenario, you will see within the equity section, outstanding shares of company stock. And then you'll also see retained earnings. Retained earnings is a cumulative account that records or keeps track of the losses or the net profits from the profit and loss statement here at the very bottom over the cumulative life of the organization. So year after year, that number adds and or decreases based on the ad accounting period's net profits. And that will tell you how much money essentially the business has retained in net earnings over the life of the organization. Any questions so far? Just want to start by breaking down those three areas, and then I'm going to dive in a little deeper as to what this statement is telling us. Within our assets and our liabilities, we can see that we have both current and long-term, or in the case of assets, we call those fixed. Just to kind of specify or detail out what the definitions are of those. Current assets are anything that is liquid within a 12-month period. For current liabilities, it's anything that's due. So if you have a note, if you took out a loan or anything, and then it's due within the next 12 months, then it would be appropriate to classify that as a current liability. And the reason that we do this is this gives management and the banks and others the ability to quickly decipher the liquidity of the business over the next 12 months, or the current liquidity, also known as a current ratio. That's what the banks will use as a current ratio, versus the long-term assets. So how much of the total debt is going to be due within a short period versus how much over the long period. And that's the complexity of this statement so far. However, most people don't want to talk about it, right? Assets, liabilities, equity, those are really painful words to say and hear. And I quite frankly would rather just be hoisting my sails and diving into the crystal clear waters in the South Pacific. But we still need to understand these things if we're going to be able to make sense of them. So the primary case that I encounter that I will say in majority of the time, most business owners, particularly the small business owners, they don't really understand or want to understand that balance sheet. So they treat their profit and loss statement very much like a checkbook ledger. That's how they view it. They have money coming in. They see the costs that are booked and assigned to those revenues, and then whatever's left at the end of the day through that net profit either leaves the business, whether that's supporting mortgages or car payments or the daily activities of living. But for one reason or another, that money doesn't usually get the opportunity to flow over to the balance sheet through the retained earnings, which can then be used to drive other business functionality. So my hope is to kind of get you to view this a little differently. I do come from a medical background. I was a firefighter for a few years, got to drive fire trucks, and was a registered EMT while I was doing that. And what I was really surprised, given my background and understanding the human circulatory systems, whether we're talking about our respiratory or our blood, our circulatory system, is how similar financial systems, regardless of scale, even the smallest of companies up to the federal budgets that we use to run full nations. If you truly understand the way they work like circulatory systems. And those who take advantage of that understanding can increase the ability of the organization's likelihood of being able to further generate cash. And I'm going to go into, on this specific slide, the difference, at least my understanding of the differences between cash and profit, and hope that that resonates with you in order for you to make sound decisions when it comes to strategic investments within the company. So as we've discussed, on our profit and loss statement, we have revenue that's generated from our operating activities, right? And so for the purpose of this conversation, I'm going to keep it simple. We're not going to talk about revenue generated from investment activities. We're strictly talking about what we're doing through our primary business activity. If we're farming, it's going to be revenue that's generated from installing hoop houses or selling produce and those types of things. We subtract the direct costs, the direct materials, and the direct labor that is necessary to generate that revenue in order to come up with our gross profit. Once we have come to that stage, we will then go through the exercise of reducing our gross profit by our overhead expenses, the fixed and variable expenses that were necessary in order to bring our product or service to market, and that gives us a net profit. If we're doing our jobs appropriately as management, we will then understand that net profit, whatever that number is, it's going to carry over to the balance sheet, and it's going to come up and it's going to tuck itself in real nicely into that retained earnings slot. In the current period, please note that you'll probably see that as current earnings. Most balance sheets will have two line items for retained earnings. One will be current earnings so that you can see what came over in the current period. And then the retained earnings, which is the cumulative from all past accounting periods. When you add those two together, that would give you the actual total from beginning to the end of the current accounting period. Once the money is in retained earnings, now management has a real challenge. we have to decipher either through the use of strategies of employing liabilities or strategies of applying assets in order to generate other or additional revenue streams, right? So this is where we really look at how are we going to invest in the business and what is the most appropriate use of our retained earnings to make investments either in liabilities or in assets that we can then use to transfer back over to the profit and loss statement to generate additional revenue. Now, whether that's creating new revenue streams or enhancing existing revenue streams, that's all part of management's strategic process. But this circulatory system, and particularly for co-ops, I'll tell you, co-ops that don't succeed or have problems with their membership and lawsuits, it's because they don't understand this concept. They don't understand your responsibility and your job as a leader and a manager of a cooperative. This is all the membership is asking you to do, is to ensure that the resources that are generated from the operational activities of the organization are appropriately reinvested back into the organization in order to provide the services of the organization and increase the short-term and the long-term wealth creation capacity of the organization for its membership. Are there any questions on that? Questions, comments, concerns?
Yeah, I have a question. So how would you determine whether to put an investment back in the co-op into liabilities or assets?
I think the easiest way to make that determination is cost of capital, right? So we have to use some of our economic principles, whether we're looking at the cost of capital or the time value of the investment itself, to make the determination of is it better for us to use someone else's money and have a liability sitting on the books to go after that strategy, or is it going to be more beneficial for us to have a reduced cash liquid position, but we're not paying interest or the additional costs to use someone else's money and have that incurred liability?
Mm-hmm. Okay.
So at this point, I think it's appropriate to kind of tell you how I view each of these statements. Earlier, I had mentioned that it's important to understand that cash and profit are two different things. And I hope that what you're starting to realize by looking at these financial statements this way is that your profit and loss statement, really the only thing that tells you is management's efficiency at creating profit. The balance sheet tells you management's efficiency at generating cash. And the two are very different things. I will tell you that from experience, businesses can survive for quite some time with cash in the absence of profit, at least until the cash dries up. Businesses can survive for a very short period of time without the existence of profit and without the existence of cash. We've all heard cash is king, or it takes money to make money. In the current business structure that we have established, these two different statements tell you, one, on the profit and loss side, the ability of the business or management's efficiency at generating profit, which the business can survive for a short time without, so long as it has cash or the ability to create cash, which is represented on the balance sheet. Help me understand how you guys were grasping that concept, or have I created more questions or muddied the waters with that?
Can you restate that, the profit and loss and the balance, the management focus?
Yes, ma'am, absolutely. So the profit and loss, what that tells me, or what it should tell anyone, is management's efficiency at generating profit. The reason for that is, as we've previously stated, the top portion of the profit and loss statement, the only thing that tells me is, have we done a good job of managing our costs or setting appropriate pricing strategies to make sure that we have profitable products or services. And then in the bottom portion of that statement, have we developed a business model that is profitable to bring those products and services to market? So in reality, the only thing this statement tells me is how efficient is management at understanding pricing strategy, and how efficient are they at controlling costs in order to design and develop products and services, and then to deliver those products and services to market. And at the end of the day, the end portion of that equation is profitability. So the profit and loss statement only tells me management's efficiency at generating profit. On the balance sheet side, you do not have the requirement of net profit to start the balance sheet, right? If we were a brand new company and we were brand new cooperative and we did a successful capital raise and membership raise, and let's say we put $100,000 of operating cash into the business from starting the cooperative, doing our initial membership drive and maybe initial equity raise. So we have $100,000 of cash that did not come from the profit and loss statement. So that is an entirely separate thing. Now it's up to cooperative leadership to make a decision on how to use that cash. We can either go buy a boat, a big fancy boat, and enjoy, a few hours in the sun, or we could actually invest that $100,000 into revenue generating activities for the business, for the cooperative membership, right? That's what they've employed us to do by signing their membership agreements. And so we use that cash to either substantiate the procurement of liabilities, like most banks require us to put some money down, right? 20% is the usual that a bank is going to require for us to take out a loan. Or we can use the cash to purchase assets that we're going to then use to start that revenue generation cycle. And that's going to be the kickstart. But that cash creation, it ultimately comes, at least on a simplified, or at least from the operations perspective of the business, that comes from the profit and loss statement, right? So because we have our revenue generating activities and the costs that are associated with that, that creates a net profit that brings the cash. The net profit becomes the cash that comes over onto the balance sheet. And then it is management's efficiency of using that cash to either procure liabilities or assets that are then used to perpetuate that cycle. Did that help?
Yeah, I just wondered, we are recipients of federal monies. They put in our wells using CARES Act, and going forward, we're looking at the same thing with the ARPA funds. Where does that go into all of this? Where do we put those?
Quite frankly, it's going to show up under assets, because I'm assuming those are grant funds that are coming in, correct?
So it would be on the balance sheet versus the profit and loss.
Correct. It'll start on the balance sheet, and then whatever you do with those assets will dictate how they transfer over to the profit and loss.
Oh, okay.
Do you have an example of the long-term liabilities?
So any like, if you took out a mortgage for a building, and let's say it had a 15-year note on the mortgage, that would be a long-term liability. If you have, most credit cards are going to fall under your current liabilities. So anything outside of short-term revolving lines of credit will usually fall to a long-term liability. If you had a 3-year, anywhere from a 3-year to a 5-year note for a vehicle that you purchased, that would be classified as a long-term liability. So anything that falls beyond that, where that total balance is due within a 12-month period, should be classified as a long-term liability.
And I really like this model. It's very helpful. So thank you for the nice model.
Yes, sir. Check your mute. I can't hear you.
So there are a number of USDA grants that require a match, 25% usually, something like that. So if our co-op were to get one of those USDA grants that requires a match, would the match part be part of liabilities?
Honestly, I would. It's going to start coming from your assets. But if you have a good accountant, what I would do is I would take your match portion and then I would approach a lender depending upon the cost that we could get subsequent funding from. And then I would use an offsetting liability transaction in order to help hedge against the risk that you've taken for the cash outlay that you've put up front for the match requirement. But that would be a strategy that not only the leadership would have to be comfortable with, but the cooperative membership would want. So that's one example of where you could use an offsetting liability to cover the match requirement for that grant as part of a financial strategy to like I said, help hedge or offset the risk that the cooperative now has because they've reduced their liquidity by coming up front out of pocket with that match requirement, right? But if it was just a straight, we're going to go ahead and we're going to put the match up front and we're not going to procure any other liabilities as a part of that process, then it would only affect your assets. It would just be a reduction of assets and not an increase to liabilities. Unless the grant had terms that the match would be returned, but I'm not familiar with any grants that have a returning match requirement. So.
No. Okay, thanks.
Any other questions on this? Okay. All right, so documentation. As a part of the foundational portion of accounting, documentation is important in order for us to validate the legality of the transaction, the appropriateness of the transaction. And then for audit purposes, obviously the auditors want to see what was procured, because we can easily put a transaction in the accounting system, but that doesn't necessarily tie out to what is recorded unless we have a receipt or some other form of documentation to validate. So documentation is important when you're putting your accounting teams and your accounting process together to make sure they understand the process that's going to be followed with filing and keeping transactions. It needs to be done in a way that it's easily referenced back to the transaction itself. The two pieces or the two images that I've included here are, the bottom one is for QuickBooks. And you see the little circle down on the very bottom, there's an attachments option. So when you're inputting a transaction, you're able to attach a copy of the receipt or the documentation directly with the transaction. The top one is Xero, and they do the exact same thing. They give you the ability to attach documentation. Quite frankly, the cost savings for organizations from not having to maintain a file system and then find somewhere to store that for 7 years and maintain that storage for 7 years makes using these types of accounting systems more than worth it, in my opinion. And in the event of an audit, you're not going to have to sit there and scrub through your receipts with an auditor. You can create a auditor's account in these accounting systems and just turn them loose. Say, here, go. You can go through and look for whatever you want. But really, that's the purpose of documentation. It's to validate the legality and the appropriateness of the transaction, and then provide auditors with a paper trail for the transactions themselves. Please forgive the background noise. All right, so with cooperatives, there are certain types of accounts that require special handling because of the nature of the accounts and because of the nature of the legal ownership structures that we have established with cooperatives. The first one that we're probably all quite familiar with is the patronage accounts. And so our patronage accounts will specifically identify the level of patronage that our members have participated with. These are going to be separate from the accounting system in that there's a separate process for recording a member's transactions with the cooperative itself. There are complementary accounting systems, and you can set up your chart of accounts even in QuickBooks or Xero or some of the more popular online or digital accounting platforms to properly account for patronage activity depending upon the volume and the size of the organization. I think, quite frankly, most modern accounting systems, if we're under $10 million of annual transactions or annual activity, they're more than capable of handling all the needs for a cooperative. Once we get over $10 million in volume, then we probably start needing to look for a little bit more robust systems to monitor and track not only our normal operations and financial activity, but also member activity. In the case of agriculture producers, I do want to put one caveat. This may be different depending upon the cooperative structure as far as buying product from different producers and how they allocate the use of patronage based on the amount of product that comes in. Okay, so really it comes down to, if you're trying to assess or evaluate what would be an appropriate size or level of complexity for an accounting system, that may be a one-on-one conversation that we want to have once we really sit down and look at what's the current size and activity of the organization, where your intended growth, and then we can look at the appropriate way to structure your patronage accounting process. But just understand that there is a separate process for accounting for patronage.
Can you give an example?
Yes, absolutely. So is everyone familiar with REI Co-op, the recreational equipment retailer? Or maybe perhaps Land O'Lakes butter. So Land O'Lakes is a dairy producer or dairy cooperative, right? And it purchases dairy products from dairy producers all around that they have contracts with. They have an entirely separate accounting process to record every time a producer brings milk in. Then they would be assigned, or they would be given credit for the number of gallons of milk that they've brought in. And then at the end of the term, or end of the accounting period, when management is looking to assign patronage dividends, those patronage dividends will be determined based on the volume of milk that each producer brought in. So they would basically take a look over, and if they said, okay, we brought in 1 million gallons of milk, and producer A brought in 200,000 gallons of that, producer B brought in 100,000 gallons of that, then they're assigned their patronage, or they're classified their patronage based on that allocation. In a retail cooperative like REI, if I spend, $1,500 throughout the year, and total revenue for the company was, $30 million for the year, then my patronage dividend or my patronage allocation would be based on my $1,500 that I spent with the cooperative. And so with the patronage accounts, that's all we're doing, is we're recording and tracking the activity of each member with the cooperative, so that we can appropriately assign not only our patronage dividends, but our equity distribution. Does that answer the question?
Yes, it does. Thank you.
Okay. Second to our patronage accounts, which monitors and tracks our activity with members, is our capital accounts. So we need to be able, and this will actually tie directly back to the balance sheet, but there are cap table requirements for us to manage as a part of SEC and IRS requirements that go beyond a standard equity account management. So that's why it's pulled out separately. And in the case of cooperatives, when we have requirements, so if your initial membership has let's say a $15 membership application fee, there would be a separate account that would be established, a separate capital account that would be established to manage and maintain that member equity for their $15 initial in their initial application for membership. And if the cooperative has began a fundraising round and is offering subsequent investment shares, then those would require additional capital accounts to be tracked per member. And everything under a capital account accounting process is what's going to be called a cap table. And I go into cap tables a little bit further in the presentation here, as far as some of the requirements that are outlined for how you manage equity, how organizations are allowed to distribute dividends, and what percentages. All of that within a cooperative structure is going to be based on patronage activity, which is why it's important to track that patronage activity in separate accounts. Does that make sense? Okay. Retained earnings. Retained earnings are going to require a separate account for cooperatives, because of the ownership structure, similar to our capital accounts. The difference being that with a capital account, the cooperative has, in essence, an IOU to its membership. With a retained earnings account, the organization has the cash, or has the cash in hand, and is likely to declare a patronage dividend if there are retained earnings, and that's what the board of directors has determined. And so the retained earnings accounts are used to track equity distributions from net profits. And then it's going to use a combination of the capital accounts, whether it's their initial membership and whatever legal structure was involved with that initial membership design, and their patronage activity to assign the retained earnings, or what ultimately becomes called or termed the patronage dividends. Does that make sense? So I know I at least had assumed we were all familiar with the terms patronage and patronage dividends, but I kind of wanted to give you a little bit deeper dive into how those patronage dividends are calculated, and then how management looks at, or what pieces of information management is going to look at in order to assign those patronage dividends. Okay. Per unit capital retains. So this one is particularly important to agriculture producers, because in organizations like Land O'Lakes, where they are not selling product back to the membership, rather than having a patronage account, what will usually happen is you'll have a per capital retains. So in the case of our dairy producers, where you had some producers that, may have been contributing 100,000 gallons of milk to the organization, and others, their varying levels of contribution. Rather than monitoring the activity of patronage, then we're going to be monitoring the level of activity of contribution. And a fancy, complicated term for that is the per unit capital retains. So that's the primary difference between those two different accounts. If you are an ag producer that is taking in product, and that is a portion of it, and you are also selling and tracking your patronage, then you would want to have both of these. And there's certainly organizations that are set up that way, so where you're monitoring not only what your members are contributing overall for your product distribution, but you also have a patronage account for monitoring what activity they're patroning from the organization itself.
In this library, we try to keep it quiet.
I understand. I'm almost done. I'll be as quiet as I can. Thanks. Member accounts receivable is if you make any sales of product and or service to the organization, and you have made it available for them to purchase on credit, then you would want to make sure that you have a member accounts receivable separate accounting process set aside for that. All right, so we've gotten through all of this, and what is the end goal for us as accountants or management leadership of cooperatives? The promises that we made to membership from the beginning was that we would not only be making products and services available for them through the cooperative, but we would also be working to establish short-term and long-term wealth creation vehicles. The short-term wealth creation, it really comes back down to patronage dividends, right? So if we look at the patronage accounts here and the retained earnings account, we now understand that it's our net profit that's flowing over to the retained earnings. And so it's the patronage dividends that are responsible for that wealth, that short-term wealth creation. If we go back and look at the circulatory system of how money moves through the organization and how we use our retained earnings to purchase either the liabilities or the assets of the organization, and understanding our accounting equation is liabilities minus assets equals our equity, then we can then see and decipher that it is our ability to use that strategic process in order to create the long-term wealth or the equity of the overall equity of the organization. Is there any questions on that? I think it's important to be able to explain this, especially when you're conducting your membership drives. Depending upon the strategic purpose of your cooperative, because not every cooperative has been set out to create wealth. There are definitely organizations that their only objective is to provide a product or a service to its membership, and there is nothing wrong with that. It's just important to be clear with your membership what your strategic plans are with the organization, because if you have a member who comes in with the expectation of not only having access to the products and services, but also that the business will function and perform like an investment vehicle, then that's how some cooperatives have gotten into trouble and have found themselves in court having to deal with those issues. So short-term wealth is created through cost price savings. So those strategies that we've discussed on the top portion of the P&L, and it's created through patronage dividends. Your long-term wealth creation is created through equity investment, either in the assets or the liabilities of the organization, and by expanding co-op membership to include more aspects of the household budget, in my opinion. So those are the different strategies that you can use to look at if the organization has a purpose of creating wealth. So that's the fundamental aspects of accounting. You know, we've covered quite a bit. And where are we at? How many time-wise? I probably took way too much time in that area. Let me go cruise through the policies, procedures, and the accounting manual. The slides will be made available to each one of you, I believe, at the end of this presentation. So you'll have access to not only the slides, but also the recording. And I won't read this to you, but please just understand that accounting policies are the rules that the organization is going to abide by as it relates to each of the different specific functional areas that accounting is going to touch. These are the specific areas that the policies need to address for cooperatives that are in addition to the normal areas that your accounting policies need to just for the normal operation of any entity. Your procedures are the step-by-step processes that your organization needs to follow when it's recording transactions. And so it's going to specify things like who's authorized to make adjustments to your chart of accounts and the process that must be followed. You know, the executive leadership team may have a specific way they want to look at the financial statements. And so there will be a process or procedure in the chart, in the accounting manual, that will outline to a bookkeeper or anyone else in the organization that if they want to make a change, add an account, take an account away, or reclassify an account, what is the process that must be followed in order for that to occur. And quite frankly, you need to have that procedure outlined for pretty much any scenario you can conceive of that you're going to encounter within the organization. The accounting manual itself is a critically important document. I cannot express the importance of this enough. To have a well-written, professionally documented accounting manual that is logically laid out so that it can be quickly and easily used by anyone within the organization that is going to be touching these different processes. It needs to use a sequencing or numbering system. It needs to have some logic behind it so that it's easy to get in and access the information within the manual. And then I try to discourage people from memorizing any aspects of the accounting manual, because if management's doing their job, there will be regular updates based on the needs of the organization as the organization grows. So it's a better practice to make sure that your staff are trained to reference the accounting manual rather than to memorize and follow the procedures and the policies that are within from that perspective. Cooperative accounting on Navajo Nation. I think to just simplify this specific topic, I'm just going to leave it that there are business codes, obviously, if the cooperative is registered with the tribal council, and they are susceptible to tribal council codes. Within Navajo Nation, those are going to be Titles 5, 5A, 12, 15, 24, and 26, depending upon the topic we're discussing. 5 and 5A primarily handle commercial transactions and business structure. 12, I believe, is labor. 15 is financing activities, so on and so forth. So the businesses are susceptible to that. However, with that being stated, if you follow US GAAP and or the more stringent IFRS guidelines when you're setting up your accounting manuals and your policies and procedures, I think you will find that you will stay out of the crosshairs of Navajo Nation auditors or anyone who might want to be looking into the books. So I'm still working to try and get a good answer from the controller there on Navajo Nation to see if there's any specific reporting requirements. But quite frankly, with my current inquiries, my answers come back to follow US GAAP or IFRS, and you should be okay and stay within guidelines. So what do you guys think accounting's role should be in the 21st century? It's changed. It's changed since 1495. And quite frankly, the current economic environment we find ourselves in, we're probably going to find that accounting's role is going to change a lot more. I have my opinions on where I think accounting's going and what I think it should do, but I'd like to hear from you guys. And I know Mark and I had a conversation yesterday, and he encouraged me to kind of help you understand where I'm at in both my personal and professional life as it relates to this subject. You know, I'd already explained that I left what I would consider to be the conventional business world for things that I didn't find fulfilling for myself in order to explore alternatives to the business structures and the economic structures that we have. And I ventured into the realm of cooperatives and employee ownership structures. But even still, I have concerns about the role that economics plays in our life and how it influences our environment and the social constructs that we have with one another. And so I think personally, I'm challenging a lot of what I find, but that doesn't mean that we don't have existing structures that we have to navigate. So I would like to hear from the group what you guys think accounting's role is to help organizations navigate this landscape, whether they're co-ops or employee-owned companies or just general structures.
Thank you, Kevin. It was a really great presentation. I think for the farm here, it was very important for accounting to be kind of almost our foundation of whether we sink or swim, and showing how farming and gardening can be economically viable was kind of what we challenged ourselves with. And so to be able to account for everything and see where things are, I think going forward into a co-op, it allows us to be very transparent with what we're doing and where things are coming from, as well as gathering all the data and what have you. So I think it's very valuable going forward. Thank you.
Thanks, everyone. Yes, sir.
I would say that in terms of the role of accounting, I think it should be to help us incorporate the things that are more culturally appropriate. For example, the sweat equity, you know, that Tyrone's group is doing with creating all these hoop houses. You know, finding ways, helping us find ways to make it work. You know, not just being sort of the policeman, but being the, yeah, I mean, and your presentation definitely helps us in that direction. So thank you.
Thanks.
I have to jump off. I just want to say how incredibly excited I was to see that you guys were putting this on, and the information was phenomenal. So thank you so much. I did try to access your webpage and it wasn't working. So is there a way for us to, like, is this something that you do for other cooperatives?
Yes, it is. And I'm aware of the issues with the website right now. So what I'll do is get your contact information and send you an email, and we can communicate that way directly for now.
Okay, thank you so much.
Thanks for joining us.
Hi, I wanted to transition our little well, it's not even at a nonprofit status. We're still working on getting our nonprofit status, but I wanted to just sort of get a hands-on and start recording things. And I just wondered, do you provide like one-on-one hands-on type thing? Because this is all new to me, and I'd like to sort of get an understanding, sort of hands-on. Not, I mean, this is a great class and good information, but all this language is really new to me. So
Yeah, I understand. And certainly that's my primary role as I work with organizations in a one-on-one setting to do cooperative development. And that encompasses everything from full startup to capital and equity raises, to making sure that the legal requirements are met for their accounting manual and the legal structures that they put in place. So certainly I'm happy to have a conversation with you and help you through whatever questions and concerns you have.
Also, I just want to jump in, thanks to this grant program, we do have funds to be able
Presentation
to.
and even sharing your experience. And I feel more confident moving forward with our organization, and even how to be accountable from the work to the finances, and even just obtaining funding. Thank you.
Good. I'm glad it helped.
Oh, sorry, just to again jump in. I just want to make sure everyone knows that we do have funds available to pay for one-on-one sessions. So if you would like to have some time to talk to Kevin about your organization specifically, just you guys, and go over things, contact me. We can get that scheduled, and it'll be totally free to you and your organization. Well, is there anything else that you want to cover today, Kevin?
No, everyone will see. I'm sorry I didn't get a chance to get through the entire slide presentation, but the slides will go out and you'll see that there's a few slides following this one. Please don't hesitate to reach out to me directly if you have questions on anything that's in those slides. And I do want to appreciate, I thank Mark for bringing up I think you really well summarized my thoughts on where accounting's role is going. And it's going beyond the policing that it is known for, to not only being data driven and helping to provide data driven answers and decisions support to leaders, but also finding way to appropriately assign value to the sweat equity and the other aspects that are a part of what we do and what we engage in. So I appreciate everyone's participation, and thank you for your time today.
And Sophia, you'll provide the recording to all of us, right?
Yes, so I will finish processing this, put it on on YouTube, and then send it out. So if everybody wants this emailed directly to them, make sure you email me. Otherwise, I'll send it to Tyrone as well, and he'll probably just send it out. So and again, contact me if you want one-on-one sessions with either Kevin or with some legal help about your cooperatives. And yeah, Kevin, don't apologize for not getting through all the slides. You provided so much information. It's very useful.
Very good. Thank you,
yeah.
Kevin.
All right. Well, everybody have a wonderful rest of your day. And thanks again for attending.
Bye, y'all.
Thank you.